use the chat box and feel free for raising the questions using the chat box. Question answer session is provided after the main session. Kindly note that the feedback with certificate generation forms link will be provided only after the discussion of question answer session, and no need to mark your name in the chat box. Thank you. Enjoy the webinar, and over to Ms. Anita Jose, Assistant Professor, Union Christian College, Alva, for the welcome address.
Thank you, Rinju ma'am. Good afternoon, everyone. A warm welcome to the international webinar on the topic Wall Street versus Main Street during the pandemic, hosted by the Department of Commerce, Union Christian College, Alva. It is a great pleasure for me to introduce our speaker for the day, Mr. Jayakrishnan Pai, Vice President, Market Risk Engines Business Analysis, Barclays, London. He is a business analyst professional with 15 years of experience in the market, credit, risk measurement, and management space. He has worked on many projects through their software delivery life cycles. He is an effective communicator among both business and technical stakeholders, adept in planning and initiating global project deliveries. His specialities include risk and capital calculation, stress testing, risk data aggregation and reporting, strategic re-architecture of legacy risk systems, risk data quality, business process improvement, and collateral management. On behalf of my colleagues of Department of Commerce and Union Christian College, I wholeheartedly welcome you to the webinar. Sir, it's an honor and privilege for us to have you as our speaker today. I'm also delighted to welcome all the participants for today's webinar. Now, without further ado, I'm turning the time over to our speaker. Over to you, sir. Thank you.
Thank you very much. So I'm Jayakrishnan. I work in Barclays. I work in the market risk department. So the topic for today is Wall Street versus Main Street. I hope I'm audible. If you have any questions, we will please raise your hands as the moderator mentioned, and I'll be more than happy to answer your questions. I've presented a couple of slides. Okay, thank you. I've presented a couple of slides, and towards the end, I would like to also share an Excel workbook describing how to compute risk. Okay, I'm going to share my screen now. Okay, so this is the agenda today. I would like to first paint a picture of what happened in the Main Street during the pandemic. I would like to take key economic indicators and help describe what happened. Then we will proceed on to see what happened in the Wall Street, what happened in the equities market, what happened in the bond market. We will go through why the difference happened, and then we will subsequently discuss risk management practices, especially the value at risk concept. So I'm taking US, the world's largest economy, to describe my use case. So what we can see on the slide is the unemployment figures hit 14.7% in April 2020. And in 2008-2009, which was the financial crisis, the max unemployment was 10%. So it is close to 40% higher than the previous crisis we had. So 14.7% in April was the peak unemployment. Now moving on to the gross domestic product, the GDP of the economy. In Q1 2020, the GDP contracted by 5%. Now the projection for Q2 2020 by the Federal Reserve Bank of Atlanta is a contraction of 52%. So let's sink that number in. The US economy is worth $21 trillion, and it's expected to shrink by 52% in Q2 2020. The numbers will be published in the few days to come. Let's hope, wish, and pray that it's not as bad as 52%. This graph shows the human impact, the lives lost during the pandemic. So worldwide, more than 10 million people were infected and 500,000 deaths happened. The graph to the right, as you can see, that's the deaths per million. There is a bit of an audio issue. If you're not speaking, please go on mute.
Yeah, sir. Now it's okay.
Okay. Right. So the graph to the right, as you can see, is still upward sloping. So that shows the deaths per million residents, right? In the United States, it's still close to 400 deaths per million resident. And the slope is still upward. It's not flattened, unlike in Japan or in Canada. The next slide is about the price of oil. The reason I have taken oil is a major indicator of economic activity, right? It's used in transportation, it's used for manufacturing. If you look at the peak of financial crisis, the price of oil measured by the West Texas Intermediate crude, which is the most traded commodity in the world, it dipped below $50. It came all the way to $30. So that's what happened in 2008, 2009, again, the previous crisis. Now, something dramatic happened on the 20th of April, 2020. The price of oil, the futures price of oil, it dipped below zero. It went all the way to $37, negative $37. So what does negative $37 means? So the buyers of oil were paid to take delivery, right? It has never happened in the history of trading, right? Buyers are being paid to take delivery. It hasn't happened during World War I. It hasn't happened during World War II. Pretty dramatic. It happened only for 2-3 days and then it subsequently recovered. But the fact remains that it happened. Okay. So I hope you're able to get a picture of what I'm trying to paint here. By taking the key economic indicators, the unemployment figure hit 14.7%, the highest. The contraction in GDP expected to contract up to 52% in Q2. More than 500,000 people lost lives. The price of oil went negative. This is the picture I would like to paint for the main street. Okay. Now moving on to what happened in the equities market, in the share market. So before I go into any further, I would like to discuss the concept of what is an index. We often hear the Sensex in India reach 34,000, 35,000. What does it actually mean? What is an index, right? So the BSE Sensex is the most widely tracked index in India. It's a collection of 30 largest companies in India, right from the familiar names of Reliance and HDFC, Infosys, TCS, Tata Steel, so on and so forth. So the 30 largest companies are collected together, and then a weight is given based on the value of the company. So the largest company in India, which is Reliance Industries, is given a 15% weightage, followed by HDFC Bank, which is 11%. Right? And what you can see on the right side is a typical trading day. Individual shares moving up and down based on buying and selling, which happens in the market. Some of the shares went up, some of the shares went down. As you can see, there are more red than green. Each of these percentage rise or fall will be combined with the weight they have in the index. And together, the Sensex or the index moves up or down. So on this particular day, the Sensex moved down 0.13%. Okay, so with that knowledge and information, I would like to now go back to the US market and describe what happened during the pandemic period. So the peak of the financial crisis which happened during the pandemic was on the 23rd of March, the Monday. So year to date, the major indices in the US, which is the Dow Jones and the NASDAQ, dipped by 25% and 30%, 35% respectively. But what happened afterwards is dramatic. By the start of June, the NASDAQ index fully recovered all the losses. It went on further and hit an all-time high by the end of June. The Dow Jones hasn't fully recovered, but still it has recovered a lot from the lows which we have seen on the 23rd of March. So from negative 35%, it has pretty much gained 25% up until the 30th of June. So let's take a step back and then try and picture both these economic figures side by side. So you have unemployment hitting 14%, your GDP hitting 50% contraction in the GDP, whereas on the other side in Wall Street, the markets are surging. The NASDAQ has hit all-time high. It makes you think, what's happening? What's the trigger for this? Okay. So what we see on this slide is widely considered to be the main driver for the share markets and the financial markets in general to be going up, right? So the US Federal Reserve, the equivalent of the Bank of England in the UK and the Reserve Bank of India in India, they provided a fiscal stimulus of $2 trillion. So that's the figure to keep in mind. It's much higher than what was introduced during the 2008 crisis. And as an absolute figure, what does $2 trillion represent, right? It's more than many countries' GDP. If you compare to India, India has a GDP of $2.8 trillion. So the amount of money which the US Federal Reserve provided as stimulus is 75% of India's GDP. That's the amount of stimulus which is provided. And look at the balance sheet size of US Federal Reserve, right? It's close to 1 trillion in 2008, and it has now hit more than $6 trillion. There were a lot of very large and strong companies before the pandemic. Most of these are very familiar to you. Your Facebook, Apple, Amazon, Netflix, Google. They were stealing the show during the pandemic. The tech companies became a lot more stronger during the pandemic. Everyone was using the online delivery systems to get essential groceries delivered. People were watching movies on Netflix, so on and so forth. The next picture which I would like to paint is how large are these companies, right? And how do they stack up in the wider context? So I'm taking Apple and Microsoft, two companies from the United States. Apple is worth an astonishing $1.57 trillion. It's very close to the entire economy of Canada. If we combine Apple and Microsoft together, and if it was a country, if Apple and Microsoft together was a company, it will be ranked number 5 in the world, ahead of UK, ahead of India. Okay, so this is the main reason why the indices were moving up. So if you look at NASDAQ, which is a very tech-heavy index, it was surging because of the tech companies and the pharma companies. These tech companies are bringing in a lot of disruption to the traditional industries. In this slide, I'm taking an example of Tesla. So Tesla is an electric vehicle manufacturer. It was founded in the year 2003. Tesla is now officially the most valuable automobile manufacturer in the world. It's worth more than $180 billion as of the 16th of June. I checked yesterday, it has now gone beyond 200 billion. Okay. Again, that's an astonishing figure, right? Tesla is now worth more than Ford, General Motors, Ferrari, Honda, and BMW put together. Again, let's take a step back and just think about it. Ford Motor Company was founded in the United States in 1903. Tesla was founded in 2003, 100 years later. The very first car was founded by Ford, which is the T model. Henry Ford introduced the assembly line manufacturing system. Right? 100 years later, Tesla came in 2003. 17 years' time, Tesla is now outpaced all the automobile manufacturers. That's the power of disruption. You can see that happening not only in the United States, everywhere else as well. Back home in India, Reliance Industries was stealing the show during the pandemic. Not a week went by without a major deal, a major investor wanting to buy into Reliance. Why? Because Reliance is disrupting the market in India. In the retail space, in the mobile space. Yesterday I read in the news that they have now come up with GeoMeet. That's the disruption which I'm talking about. And that's bringing in a lot of value in the market. So Tesla increased by 375% over the past 1 year. Okay, I would like to take a pause and take any questions you may have.
Participants, you can now raise questions in the chat box. Sir, one question is there. Hello,
Yes,
sir.
sir.
Yeah, okay. How long fuel rate direct Main Street, US and main countries now switching to electricity resources? Question is
So
clear, sir?
if I understand, yes, I believe so.
Okay,
Yes.
okay.
I think the switch to electric vehicles is going to take some time, especially in the emerging markets, including India. Because electric vehicle cars are pretty expensive even now. A typical Tesla will cost you upwards of $30,000. So the cost of electric vehicles needs to come down, and a lot of charging points so that people are able to use it. So I don't believe it's going to happen. The fossil fuel-based car, I don't think it's going to go out of market in the next 15, 20 years, but you will see more of it. You'll see more of electric vehicles coming in, especially in the Western world first, and then subsequently in the emerging markets. Okay, I hope I answered your question. Thank you.
Hello,
So
sir.
the next question, yeah.
Next question
the next
is
question,
how will you evaluate the stimulus package announced by the government of India?
I think the stimulus package announced by India is equally important and relevant for the government for India. We cannot have a direct comparison between India and the United States because of a number of economic factors. Right? Essentially, the government is borrowing money to provide the stimulus. So now you have a catch-22 situation. If you borrow a lot of money, your rating is going to go down, and it becomes more difficult and more expensive to borrow money. So there is a fine balance which all the economies and governments are trying to do. So in the light of everything, the economic factors, the rating, the fiscal deficit, I believe the stimulus package which was announced in India was really helpful, and it will help the country to come out of the recession.
Okay, it was a question from Sunil, and hope it is understood. Next question. Sir, you mentioned about the US share market and the impact on the economy because of the stimulus packages. Looking at the increase in COVID-19 numbers, you would assume that the share market would react to it. Why is that not happening?
Yeah, no, precisely. I think the major indices which we saw, right, especially the NASDAQ was really going up. So I think the devil lies in the detail. There are a lot of companies which have really gone down. But because of the tech-heavy nature of the indices, because of the size of the tech companies, they are actually pulling up the share market. But if you look into housing, if you look into consumer discretionary, if you look into aviation, all these sectors are deep in the red. It has negatively reacted. It's just that very strong companies, especially the tech and pharma companies, have come stronger, and they were pulling up the share market.
Okay, sir, next question. If US and all changing their manufacturing from China to home country, what would be the impact of related rate of goods in future?
I think it's going to happen, but it's going to take a long time. The other day I was reading on the Economic Times that yes, there is the talk of manufacturing shifting away from China and to other Asian countries. But there is a long way to go. If you look at pharma, the active ingredients which come into the manufacturing, so India is the largest manufacturing hub for pharma, but the active ingredients which goes into the pharma industry, they internally comes from China. So it's going to take a good long time if you are to become independent, if you are to move away from China and build a very strong manufacturing hub, either in Vietnam or in India, it's going to take some time. I don't think it's going to happen in the next 2-3 years. But I genuinely feel that there is a lot of companies which are trying to bring back manufacturing into the home countries, especially in the United States.
Okay, sir, next question. If US and all changing their manufacturing, okay. Next question is that what will be the economic implications of the tensions between India and China in the international context? What will be the economic implications of the tension between India and China?
Right, I think it's still an emerging story. I'm not really an economist to comment on that. Again, in terms of China is very strong in manufacturing. India is very strong in services. Historically, that has been the case. Right? The language barrier is a strong barrier for China to compete in the services sector. And likewise, it is very difficult for India to compete at the same level in manufacturing with China. The entire infrastructure needs to be there. So again, I don't see an immediate impact, but the policies which are going to decide the future, I would say.
Okay, next question. How far stimulus packages can help the market if other sector doesn't bounce back? What is the time span we are looking for the impact on stimulus to continue?
Right. Stimulus can do only so much. I think we are really wishing and hoping a vaccine or a cure or a drug for COVID-19 comes out. That will be the real game changer. We are already seeing the markets and the various sectors moving the moment there is a news about University of Oxford being successful or near to being successful, the Serum Institute in India being able to produce vaccines. I think vaccine and drug will be the key factors which will drive the markets and the economy, right? Stimulus can go only so much. I think pretty much all the economies have tried their level best in terms of providing the stimulus. There is no free lunch. If any government is providing stimulus, at some point, it needs to be clawed back one way or the other, whether it be increased taxation or higher inflation, something is going to give. Right? So that's why most of the economies in the countries, the governments, they're trying to reopen the economy because they cannot continue to support industries beyond the point.
Okay, hope it is clear for you, Sajid. And next question, regarding the Government of India package, will it increase the demand in the economy, which is the need of the hour? I think the present package can have a long-run effect. What is your view?
Again, I believe so. The stimulus has done what it was supposed to do, to give a kickstart, right? To make sure that the pandemic the recession doesn't become a depression, right? The last depression we had was the Great Depression of 1930. So all governments are trying their best to make sure that it doesn't become a depression, right? It is a recession, and we are trying to contain it as a recession and not let it slip into a depression. The economies where the restrictions have been lifted, typically China has fabulously bounced back. The unemployment figures which came out a couple of days ago in the United States, still very positive. So from 14%, the last numbers I read was it has come down to 11%. So almost 30% increase in the past 2 months in terms of employment figures. So a bounce back will soon happen because this is there is no structural issues with the economy. The pandemic caused shutdown, right? So everyone is waiting for the economy, the lockdown to be ended and for them to come back. So the bounce back is expected to be a very sharp one. And typically the economists call it out as a V-shaped recovery.
Okay, sir. Next question. Is it really a situation of rising of Wall Street now and nearby future?
Do you mean to say that? Sorry, I didn't fully follow the question. Are we saying that? Do you expect the indices to go further up? Is that the question?
Yes, sir. That's the question.
Right. So my personal view is that it's not going to continue. It cannot continue going up forever, right? At the moment, what's happening is there isn't many other choices left. So if people want to park their money, if you think about it, in the Western world, the rate of interest is very, very low. In the United Kingdom, if you invest in a bank, you get less than 0.2% interest or 0.5% interest. Similar situation in the US. In Japan, the rate of interest is negative. So you're not going to earn money by keeping it in the bank. So then the alternative is you can invest in equities market, you can invest in property market. Property market is completely standstill, right? So then you can invest in equities market. In the equities market, pretty much every sector is going down. So companies and sectors which are strong are getting stronger. So there's a lot of money chasing too few companies. The moment the economy opens up, I think other sectors will soon catch up. At the moment, it's just IT and pharma which is stealing the show.
Okay, sir. Next question. The indices in India has not much affected due to the pandemic outbreak. What might have the reason behind it? Should we exceed a huge crash in the market soon?
I think the indices in India, again, if you think about it, the biggest weightage in the index is Reliance Industries with a 15% weightage. It has in fact gone up. The next one is Hdfc Bank, which took a big hit, but again, it's expected. It doesn't have as much bad loans compared to a lot of NBFCs, which has gone, which are seeing a lot of issues with the loan repayments. So Hdfc Bank is the next one. The third is TCS and Infosys, again, IT companies. So it's the very nature. I think the major indices are, in this particular situation, is not a good reflection of the wider economy, and hence my topic today and my theme today, right? I genuinely feel that it's not truly reflecting what's really happening in the wider economy and the wider number of companies we have. If you look into Tata Steel, if you look into airlines companies, the share prices have really gone down.
Hope the answers are clear for you all. Is there any further more questions? You can use the chat box. Okay, so one more question. Travel and entertainment industry has been highly impacted due to COVID-19. It makes sense when the tech share prices goes up, but the share prices of airlines like Delta and entertainment companies like Disney are slowly recovering. How can that happen?
Right. So the airlines sales really came down in the height of the pandemic. And then there was news about the US government helping out the major airlines. So on the airlines, that was what's happening. The stimulus has really helped the companies come up. So the US government has given, not a guarantee, but an indication that they're not going to let the airlines go bust. A similar situation is happening in the United Kingdom as well. There is ongoing discussion. It's called Project Birch. We are still awaiting the announcements to come from the Chancellor, but it is widely expected that there will be more support for the airlines from the government. Disney is an interesting one. The Florida, the real physical location of Disney is closed, but they are doing extremely well on the digital platform. Right, the Disney's digital platform is doing extremely well, and all the kids are staying at home. They want to be entertained, so they log on and watch the Disney Plus. So it's the digital part of Disney which is helping entertainment companies. Similar story as Netflix as well.
Okay, hope it's clear for you, Yamini. Next question. What will be the future scenario of investment? This pandemic situation have shown some of the sectors are making remarkable growth and some are in extremely bad condition. Please suggest for upcoming entrepreneurs.
Right. I think it goes back to the disruption example which I took. Every crisis, there's a very famous saying on the financial market: never let a crisis go waste. You have to learn lessons from it, and new ideas, new companies will emerge, right? Demonetization, right? A lot of people had bad experience with the demonetization, but there were some good things to come out. Some companies capitalized on it. So Paytm was a big winner from the demonetization, right? So similarly, I would expect big investment themes coming out of COVID-19, right? The logistics sector has dramatically reshaped. There's a lot of focus on e-commerce. Amazon is doing extremely well. In India, companies like Flipkart, people are relying on it. People who have never used e-commerce sites have started using it. Now, one can argue that not every customer will stick once the lockdown is over, but a lot of customers will continue to stick on to it, right? So that's an emerging theme which comes up. Right. So now going back to the question, I don't think I have a ready answer which sector will emerge, but you can see themes coming out, right? Companies with digital platform, companies will try and be as nimble as possible, right? They will try and reduce the overhead cost. Working from home is hugely encouraged. And then it has implications on other sectors, right? In the United Kingdom, one of the largest mall operators went bankrupt the last week. So things like that is going to happen because every action has an equal and opposite reaction somewhere else. So one need to carefully look at investment themes and sectors and identify which one is going to stay as it is or which one is going to emerge much stronger.
So one more question is there. How could floating shares badly affected companies at the stock market at this juncture?
By floating shares, you mean the initial public offer, the IPO? Okay. Generally, people shy away from accessing the markets at this point. There are hardly any IPOs which I have come across during this period. It's like selling your house. Would you put up your house for selling during this market? Unless you're desperate, you wouldn't. So it's a similar story as well. I think a lot of people are sitting on the fence for things to improve, to come back. So things like IPOs, mergers and acquisitions, they're all very, very infrequent at the moment. If you look in India, I haven't come across any major IPOs. The only one company which was able to attract a lot of investments during this pandemic was Reliance Industries, which we touched upon earlier.
So one more question. Will the disinvestment target of the government of India be achieved?
Disinvestment target.
That's a very good question. Yeah. I think if you look in the history, the government of India has never managed to fully meet the disinvestment target before. Right? Personally, I'm tempted to say that it's not going to hit the target. Even if it does, see, the key thing is you can always sell a company, a share, or any product. But what really matters is, are you going to get good value out of it, right? You don't want to see a fire sale. You want to make sure that the disinvestment is happening at the right price. Otherwise, you can tick a checkbox, but you're not going to get the price what you expect, what the real price you would ideally want from those. So disinvestment of PSUs at any price is not the right thing. So if the government is looking for disinvestment at any cost, I believe it is definitely possible, but getting the right price might take some time.
Hope it is clear for you. Next question. Will the privatization of certain sectors would help to overcome the recession in this pandemic situation? The privatization of certain sectors.
Again, I'm tempted to say yes, but more than privatization, what the distinctive factor is, are you able to adapt? Are you able to innovate? Are you flexible? That's the key thing. Generally, we have seen that the private sector is more nimble, they're more flexible, and hence they are able to adapt. And hence privatization is considered more beneficial or more effective. But there is nothing which prevents a public sector firm in doing the same. So more than public or private, I believe it's the ability, the willingness to innovate and be flexible, which will help us overcome the recession.
hope there is no more questions. Sir, you can continue.
Okay, thank you. So I'll continue to share my screen. Okay, so far we touched upon share markets. The prices go up and down. Now, the next topic which I would like to discuss is risk management, typically, and especially market risk. So what is market risk? It is the risk that the value of an investment may decrease due to the changes in market factors. What are these market factors? So if you're trading commodities, it's the price of commodity. If you're trading oil, it's the price of oil. If you're trading gold, the price of gold. Foreign exchange fluctuations, equity prices, interest rate moves, these are all market factors which impact the value of your investment. All the banks worldwide are required to report and hold capital against market risk. The standard method for evaluating market risk is the value at risk methodology. Now, what is value at risk? Value at risk is defined. It is the maximum amount expected to be lost over a given time horizon at a predefined confidence level. Let me just break it down for you. If you say that as a firm, as a bank, you would need to know what is the maximum amount of loss you can lose in a particular time frame, whether it be 1 day, or 1 month, or 1 year. Right? So if you say that the 95% 1-day VAR is $1 million, what it means is there is a 95% confidence that over the next day, your portfolio is not going to lose more than $1 million. Yeah? We're not 100% sure. You cannot be 100% sure unless you say that I'm not trading at all. If you're trading, there is a possibility, right? So with 95% confidence, you can say that you're not going to lose more than X amount. So that X amount is what we call as value at risk. Now, the next question is, how do you arrive at this magic number, right? There are various techniques used by banks and trading firms to arrive at this number. The most common one is the historic simulation method. The next one is the Monte Carlo simulation method. So today I will take, using an Excel workbook and using real data from the Indian market, I have prepared a workbook which I will happily run it past you. Okay, so first I would like to, break it down, the steps which are involved in the computation of VAR. So we use the word historic simulation. What does it essentially mean? It relies on the principle that history repeats itself. Whatever happened in the past, if we go back in history, if you take a sufficiently long history, there is a high likelihood that similar situation will happen going forward as well. That's the foundation, that's a very basic principle of historic simulation. So whosoever is doing the modeling can decide how far back in the history you want to go. The further, the better. So in my example, I have taken 100 days of history. I went to the National Stock Exchange. I typed in Reliance Industries. I downloaded the data. All this is free and available to everyone. Now, this is how the data looks like. On the 1st of July, 1,737 rupees is the price of one share of Reliance Industries. Now, let us say an individual, Ram, has a portfolio of 10 Reliance shares. It means today, on the 1st of July, it is worth 17,376 rupees. So that's the value of his portfolio. Now, from Ram's perspective, his biggest worry is what will happen tomorrow? Is that going to go down? Is that going to be going up? Is there a realistic way we can predict that? If we can, then Ram can have a very peaceful sleep tonight, right? Right. So the next, I would like to introduce everyone to a term called delta. In simplistic term, delta means for every unit change, say 1%, how much money you're going to gain or lose. In this example, the delta will be 173 rupees. So if Reliance shares move 1% up, he's going to gain 173.76 rupees. If it's going to go down, he's going to lose an equivalent amount. Right. Now we are going to look at the history. Historically, how much movement has happened every day in the past 100 days. So I need to simulate that, and hence the word simulation. Okay, so in the steps, I covered step number 1, which is to source the data. The second one is to calculate the delta. So the delta is just 1% change, how much money you're going to lose or gain. The next one is to compute the day-on-day percentage change in returns. Right? So how do you do it? It's a very simple calculation. You compare the two price and say what was the return. Right? If you look into the formula, it's a very simple one. You compare these two and find the percentage return. So from the 30th of June to the 1st of July, the price increased by 1.97%. And so on and so forth. Now, if I scroll down, you can see that typically on a normal day, it either goes up by 1% or go down by 1% or lesser. There are some days on which it moves up, say 5% and 6%. It is these big moves which the investors are worried about. The smaller moves is okay. It's the real big moves which are, on the positive side, it's okay because you're going to get the profit. The negative side, which is more worrying. Okay. So now let's have a look at the pandemic period, right? So if I stop somewhere here, on the 19th of Feb, the price used to be 1,500 rupees. Then look at the share price movement. Pretty much every day, it's going down. Look at what happened on the 9th of March. It went down by 12%, followed by another 7%, followed by another 8%, followed by another 5%, right? The biggest loss, even in the Indian market, was on the 23rd of March. You may recollect from my previous slide in Wall Street, there again, it was the 23rd of March. So 23rd of March was widely considered for pretty much the global markets to have hit the lowest point. And as you can see, from 1,500 to 884 was the journey of Reliance, right? So as an investor, that person would have lost almost half his income, half his wealth. That's a very, very serious outcome. Right? In this particular example, we are talking about an investor having 17,000 rupees, so he would have lost half of it, close to 8,000 rupees. Now look at the big firms, like the pension funds, banks, so on and so forth. Large investment banks typically manage anywhere upwards of $500 billion of wealth. So what we are saying is in 15 to 20 days, a large investment bank would have lost or would have seen the value coming down by $250 billion. That's enormous. And that's exactly the kind of things which the risk management, the market risk department would like to shield against. I'm not saying that they would have lost. Definitely they would have taken actions in between to limit that. So how do you do it is pretty much what I'm trying to convey using these slides. Right? This is a graphical representation of what I just described to you. From the 3rd of Feb, from somewhere from 15th of Feb, where we had close to 1,500 rupees, it plummeted to 884 on the 23rd of March. And subsequently, it recovered. Just look at the 2 days. The 23rd of March, it plummeted. The next day, it increased much higher. That's the volatility we are talking about. That's the uncertainty we are talking about. And then it again goes down, then again it goes up. Right? Now, coming back to computing the value at risk. So we covered the day-on-day change. We got the returns. Now, how do you compute the simulated P&Ls? Step number 4, your delta, which is 1% change, will lose 173. So 2% will be double that. So close. So 1.97, 341 rupees of gain is what RAM can expect if tomorrow the market moves 1.97%. Instead, if what happened on the 30th of June is what is going to happen, he's going to lose 192, right? So on and so forth. So now let's look at what would have happened to Ram on the 23rd of March. On the 23rd of March, he would have lost 2,285. And on the 25th, he would have gained 2,557. So the next step is for me to order the P&Ls in the ascending order. So I reordered these P&Ls in the ascending order. So 23rd of March, the worst loss, followed by the 9th of March, so on and so forth. Now the value at risk figure, we are talking about a 95% probability, 95% confidence. We took 100 days. So the 5th worst loss is the value at risk. So with 95% confidence, we can say that the losses tomorrow will not exceed 1,774. If you are trading on an exchange, the National Stock Exchange will collect margins to cover this value at risk. They're not going to collect exactly 1,074. They will be collecting more than that. A minimum of 1,074 will be collected. Now it all depends how much the exchange wants to be conservative. So based on that, a multiplier will be applied to it. So the idea is to protect it against a potential loss, and hence RAM not paying the exchange what it is due. Okay. Now I would also like to show you the principle behind it from a mathematical or statistical point of view. So we all have learned about two basic concepts, which is the mean and the standard deviation, and the bell-shaped curve, which is a normal distribution. So what's the basic principle of a normally distributed curve? The key principle based on which the risk management is built is the fact that if you take two standard deviations from the mean, it will cover 95% of all possible outcomes. If you take three standard deviations, it's going to cover 99.7% of all the occurrences. Now let's have a look whether it was true using real data which we have gathered for Reliance Industries. So the mean is 53.45, right? So the average for Reliance is 53.45. So on an average day, you can expect you to gain 53.45. What's the standard deviation? The standard deviation is very high, 697, as you can see from this graph, right? It's very, very volatile. 3 standard deviations, 3 times is losing 2038. 2 standard deviation is 1341. So I have plotted these onto the graph, right? So 2 standard deviation, 1341 on the negative side and the plus side, right? And mathematical principles tells us that all the observations, there is a 95% chance that it will fall within the 2 standard deviation. Now let's look at our VAR where it did fall within 2 standard deviation. So 1074 is within the 2 standard deviation, right? The pandemic was a unique event. It doesn't happen every now and then. It's a black swan event. It's an outlier, right? Which we can again see from the statistics, right? So 3 standard deviations, which is expected to cover 99.7% of all outcomes, was 2038. But on the 23rd of March and on the 9th of March, it exceeded the maximum losses predicted by 3 standard deviations. So clearly an outlier. Clearly something which happens once in a lifetime, right? It happened not only on the negative tail, it happened on the positive tail as well, right? On the 25th of March, there was a 14% increase, which resulted in 2,557 rupees. So let's look at the 3 standard deviation was 2,145. So on both the negative and the positive tail, there were outliers. So this is how value at risk is computed. Of course, there are more complexities you can get into. You can have the modeling much more sophisticated, but in a relatively simple terms, this is how you compute value at risk. Okay. Any more questions?
Sir, there is a question. How to grow industry, especially hotel industry after COVID-19?
Hotel industry, I think there is a place for hotel industry. Everyone would like to go out and have a nice meal. I don't think it is going to die down. It's a matter of, I think they're all waiting for the economy, the lockdown to be lifted. Again, some of the companies with heavy balance sheet may face some challenges in servicing their interest debt and so forth. But I would, from a demand perspective, I would expect the demand to soon pick up. I really don't see the reason why demand will not pick up.
Participants, you can raise questions through chat box.
Okay, I can see a question coming in from Abhijit regarding the scams of Nirav Modi and Vijay Mallya. That's a very interesting topic again, right? If you take a step back, every bank would like to lend money to prime customers, right? So Vijay Mallya or any of these big corporates were prime customers in the peak of their career. Banks were competing to provide them with loans, right? So if you really want to avoid scams, banks should not be diluting their basic principles. They should stick with the corporate guidelines. They should stick with risk management principles. They should take in enough collateral to cover any losses. I think that the answer is as simple as that.
So one question is there. Sir, could you say something about the people got mental addiction in playing investment securities?
Absolutely, absolutely. So I would like to first give a statistic, which is 75% of all retail investors lose money in share market. Everyone feel that it's very easy to make money. It's not. Again, in order for anyone to become an accountant, you have to learn for 5 years. You need to gain a degree to become an accountant. If you want to become a doctor, likewise, you need to have 5 or 7 years of education. A lot of people think that in order to become an investor, a trader, you can just open up an account in ICICI Direct or Zerodha and just start trading, right? That's a mistake which a lot of people are making. From my own personal experience, what I have seen over the past n number of years is you really need to watch market. There is a lot to learn. If anyone wants to start investing, I think the first and foremost thing is to start watching the market. Make investment hypothesis. You don't have to have sophisticated tools. You don't even have to have money, right? You can just take a pen and paper. Let's take an example. What will happen to Shobha Developers, right? It's a well-known name in India, in Kerala. At the moment, the share prices have gone down, right? Before investing a single penny, you need to have a hypothesis. Why should I buy that security? Do I believe that from next month onwards, Shobha Developers will be able to sell all the houses and able to recover the money? So on and so forth. Write down the price at which you are planning to buy. What's today's price? If I'm going to buy today, note down the price. Watch the price every day. Track the news, how it is developing. 1 month later, evaluate yourself. Was your hypothesis correct? And do that multiple times and see how good or bad you are. And then change your hypothesis accordingly. And only then start putting in real money. That will be my simple and humble advice. And going back to mental addiction, sorry, I didn't answer that question. Yes, it is addictive. It is depressing. In the United Kingdom, it's 2 months ago, a very famous fund manager who was awarded the best fund manager in the year 2018, unfortunately took his own life during the pandemic because he saw his funds drastically declining, right? So a lot of people are not able, they are good at booking profits, they're not good at booking losses, right? It becomes addictive. You lose 10 pounds or you lose 10 rupees. The next bet you make, the next trade you make, you would like to recoup double the amount. And as you can clearly see, it can quickly become a downward spiral. You put more money and you keep losing, right? And once you need to have rational decisions. You need to be unemotional if you want to get into trading, especially trading. For investing, you can still be a bit more relaxed. If you're into trading, it's cutthroat. You need to have very rational thinking, and you should be in a position to cut your losses. That's more important than booking your profits.
Okay, sir. Next question. What special factors we should consider of not losing in share market in both short term as well as long term? What are the factors you have to consider?
Right. I think there is no right or wrong for investing, right? There are some very famous iconic figures which people talk about, like Warren Buffett. But everyone needs to think, is the style going to suit me? Let's look at Warren Buffett's famous value investing style, right? His principle is very basic and it looks very simple. Before investing in a company, look at the products they make, decide for yourself, do you like the product? Is that the best product you can get, right? That was his line of thinking. As a school-going child, he really liked Coca-Cola. When he grew up, he started using Gillette for shaving. He started using Bank of America credit card. He started buying shares of these companies. He held on to Coca-Cola. He held on to Gillette for years, right? And compounding is a core principle which a lot of people forget about, right? If something is compounding at 10%, it's a fantastic investment. You need to have the patience for it to keep compounding, right? Now, it worked for Warren Buffett. He made a lot of money, right? But it also depends. But it assumes that you have a fair amount of capital to start with. If you have only 1,000 rupees in your pocket and if you want to follow the same investment principle, it's going to take many, many years for you to get a meaningful wealth and income out of it, right? So it cannot be your full-time activity if your capital is low. Then you may want to try out trading. And hence, the style which you want to pursue, it depends on your personality trait, it depends on the amount of capital you have, it depends on the resources you have, right? It's all about having information to do the trade. A very simple example I can take is once the information is out there, it's no longer useful. Right? So you need to be in a position to do research and predict the future. That's how you can make money.
Okay, sir. Thank you. Next question. How far was the beta has been impacted with this pandemic for NASDAQ?
Right. Let me first explain what beta is. So beta is the correlation of a security with the index, right? So generally beta is positive. It means when the index or the general market is going up, there is a sense of relief, there is a sense of euphoria, and people generally go and buy the shares, right? So to answer the specific question, yes, beta has definitely played a big role in the run-up in the NASDAQ index. Once Amazon goes up, a lot of other e-commerce companies go up. Once Tesla goes up, the other electric vehicle companies go up as well. There was one of the companies in my slides, which was Nikola, is the name of an electric vehicle manufacturer. It has a market cap of $20 billion. It hasn't marketed, it hasn't mass-produced electric vehicles yet. Just think about it, right? Not a single car has been commercially produced by that company, but it's now worth $20 billion. Very close to Ford Motor Company, which produces millions of cars every year. So it's all about expectation.
Okay, sir. Next question. Participants, please mute the mic. Okay, sir. Next question. How is blocking of FDI from China going to affect startup in India, as most of the startups are funded by Chinese investors?
Yeah, I personally feel that there is going to be at least a short-term negative impact on startups. Let's look at the largest startups in India, right? Like Paytm, for example, or Oyo Rooms. They all had major investments coming in from the likes of, say, SoftBank, right? SoftBank is not really a Chinese company, it's a Japanese company. But the point I was making was at the moment, the startup culture in India is still emerging. There aren't enough venture capitalists and private equity investors to support all the startups which are cropping up in India. Let's take majority of the fundraising, or pretty much all the fundraising which Reliance did was from abroad. So at least in the short term, I would expect the startups to suffer because of the blocking of the FDI. But again, it may mean that some other opportunities open up, but only time will tell.
Okay, thank you, sir. Next question. In your experience, can this model be effectively used in predicting future share price, keeping aside the outliers like this pandemic?
Right. So the value at risk and the methodology which I showed is, I definitely would like to make it abundantly clear that it's not a trading tool. It's a risk management tool, right? It's used by banks, it's used by professionals to manage the risk based on the core statistical principle that using the 3 standard deviations will cover 99.7%. That's the core of that whole modeling, right? It's not very effective from a trading perspective, because all what you're saying is yesterday I had 2% dipped, day before I had -3, so on and so forth, right? So for predicting future prices, there are other techniques. This is more from a risk management perspective to help have capital set aside to cover future losses.
Okay, moving to the next question. With COVID cases rising as the lockdown eases, is it worth the risk having more people contracting COVID-19 in order to save and maintain the economy?
Again, a very, very, very tough one. So one of the conversations which I have in my household is that we are lucky to have the luxury of staying indoors and being able to work from home. Not everyone is. So it's a fine balance, right? A lot of individuals cannot afford to continue to remain at home for extended periods of time. So it is more of a necessity than anything else.
Okay, next question. Sir, is the volatility in the market, as you said, put the gold price up? I mean, switching off shares and switch on to the commodity. That's it.
Yeah, absolutely. So when I was preparing my slides, I was very tempted to put a slide on gold. So I'm glad you asked it. So gold is considered a very safe investment. It has happened during the previous crisis. It did happen during the COVID-19 period as well. Again, why so? Right? So large institutional investors or retail investors, they end up in a situation where they don't have other safe opportunities to gain income and wealth. All the central banks slashed interest rates. So you're not going to get money, good money, from investing in fixed income or from deposits. The share markets are volatile, right? It did go up, but it is very volatile. So not everyone will be comfortable doing that. Property market is completely at a standstill, and property market also needs huge investment. You cannot buy a quarter of a house. You need to buy a house. So then the next best investment for a lot of people is gold. So gold did go up during the volatile periods. And if you plot the graph of share market decline, you can see a corresponding increase in the gold price going up. So even during COVID, that relationship did hold good.
Okay, next question. At what extent we could rely guides or mentor from renowned securities?
Right. Again, a very, very, very good question. So There are very strict guidelines from the regulators like the SEBI and in the US from Securities Exchange Commission, so on and so forth, that advisors are not supposed to mislead investors. They are expected to have a disclaimer if they have an interest in the security which they are discussing. So if I'm an investor, if I'm an advisor, if I hold a particular share, then I should, if I'm discussing that particular share, then I should have a disclaimer whether I'm long that security, I'm short that security, so that my own advice is not driving the share price up or down. So, but still, there are situations where some people are misguided. There are WhatsApp messages wherein misinformation is given, so on and so forth. So everything, I would say, you need to take with a pinch of salt. You should not blindly follow anyone. You need to convince yourself whether what they're saying makes sense to you.
Okay, next question. How the progress of artificial intelligence helps in investment banking?
Definitely. Artificial intelligence is definitely emerging as a big theme in investing, but it's very, very sophisticated. It's very difficult for retail investors to get into that sophisticated modeling which is required for artificial intelligence. But yes, it is definitely coming as a very big in the institutional investing world, mainly in identifying patterns and predicting what might happen in the future, so on and so forth, based on huge amount of data. So using artificial intelligence and data science, you can analyze and evaluate huge amount of data and make programmatic, make algorithmic decisions based on that.
Okay, next question. Can you suggest few shares for a new investor who is planning to do a business in share market? Save shares to create interest as a new investor.
Right. Unfortunately, I'm not gonna pick out any shares. It definitely wouldn't be right. But Sunil, what I can definitely suggest is, as I mentioned, I think one need to be convinced on, you need to read up, you need to form certain hypotheses. I can give you some pointers which can help you, right? So currently, let's look at Nestle, right? Nestle share price did go down a little bit, but are people going to continue to eat Maggie or not? Whether the coronavirus situation has impacted people buying less of infant milk products or not. So you need to form a hypothesis based on that, then identify the companies, and then initially I would say start monitoring them rather before putting in real money. That would be my advice.
Okay, next question. How would you value a company with a negative historical cash flow? Negative historical cash flow.
Right. So discounting future cash flows is the most commonly used method for valuing a company. But nowadays it's considered it's not considered very effective, right? I can give you two examples to illustrate my point. Let's look at Reliance Jio. For 10 years, Reliance Industries, the parent company, was continuously investing money in the telecom industry. Not a single penny of cash flow was coming back, right? But you cannot say that the company is not valuable just because it's not having cash flows. Amazon is a classic example. Even now, the founder of Amazon, Jeff Bezos, believes that he needs to invest for the future, for growth, and not for income, right? So any money which accrues in the business is continuously reinvested for future growth. So you're not seeing a huge amount of positive cash flow, but you need to also look about the growth, about the market share which any company is gaining. whether it be Reliance, whether it be Amazon. So gaining of market share and the growth should also be brought in. You cannot value a company just based on cash flows.
So next question. Which investment portfolio is more profitable during this pandemic period?
As much as I'd love to answer that question, I will resist from answering that question, right? You need to make your own judgment. You need to, again, I'm going to repeat what I just said. You need to hypothesize, you need to evaluate yourself, you need to convince yourself, you need to have some ideas on your own, because investing is easy. When to cut your loss, when to book profit, it's all part of the journey, right? So no advisor can give you a tip and then just go away, because the situation may completely change overnight, right? If you are, take an investor in China who is invested in, say, TikTok, right? TikTok is not a publicly listed company, but nevertheless, there are private investors. Overnight, India banned it, and they lost, the estimate is $6 billion of loss in TikTok, right? Just one day changed the fortune of the company, right? So you need to continuously evaluate the developments which are happening in the market. You cannot just go to an advisor or pick up a share and then just not worry about it. You need to constantly evaluate what's happening. If you don't have the time and the skill set to do it, you just need to rely on professional investors and rely on things like mutual funds, wherein you entrust your money to a professional fund manager and he makes the investments for you.
Okay, sir. Next question. Is this pandemic situation have a direct impact on the gold standard?
I don't think so. If anything, gold gains more prominence during any recession, right? Gold being considered as a safe haven increase its value during recessions. So I personally don't think it has a direct impact on it, or at least a negative impact on the gold standard.
Okay, so next question. As you talked about Tesla's product being disruptive and its impact on the share prices, if you look at the security filings, you can see that they follow some questionable accounting practices. Will you, as an investor, ignore those red flags and give more importance to the product they offer as an investor?
Right, absolutely. So again, Tesla is a classic example, right? So here is where one need to make some subjective decisions as well, right? There are these mavericks, right? So I would call the founder of Tesla, Elon Musk, a maverick, right? He's not the traditional guy. He sold PayPal. He got, if I remember correctly, he got close to $200 million by selling PayPal. He invested $100 million in Tesla. He invested another 60 or 70 in SpaceX, where he wanted to send human beings to moon, right? At that time, it was considered a fantasy, right? No one believed in what he was saying, right? And everyone read last month or so, NASA has now contracted SpaceX to send satellites into the orbit, right? So these innovative peoples are often mavericks, and they follow certain practices. Some of it may not be palatable to the more traditional, more conservative line of thinking. Accounting practices, definitely, they should be following the standard US GAAP practices. If they're not, I'm sure the SEC and their auditors will pick on them. But yeah, in terms of whether looking at the product, yeah, it's a conscious decision people need to make, right? Let's take Wirecard, which recently went bankrupt, which was one of the biggest payment processors in Germany, right? It was having a fantastic run over the past 2-3 years. There were a lot of critics which were raising red flags, saying that there is something not right about Wirecard, right? But investors continue to ignore it because it's very difficult, right? You're seeing everyone buying into a particular share. The share is going up. You have certain principle. You stay out on the fence, and you think that, no, I'm not going to do that, right? You wait for 5 days, it still goes up. You wait for 10 days, it still goes, right? And then you're tempted. Okay, let me also jump into the bandwagon. That's what happens mostly to the retail investors, at least. So yeah, my simple answer would be to stick by your principles. If you feel that something is not right, stick by it. Look around, diversify. Do not invest in one particular company just because it's going up, right? If you just rely, preserving your capital is more important, right? You can't forego your money not doubling, but can you afford to lose 50% of your wealth, right? I think that answers your question, or that'll help you to make a decision.
Okay, sir. Next question. Which investment portfolio is safe and best industry in the existing world?
Yeah, no, I'm not going to give a straight answer to that, right? But I can take two examples to illustrate the point again, right? The other day I was reading about a company called Relaxo Footwear in India. Relaxo Footwear, right? It went up like 100 times in the past 10 years, right? So if you were a lucky investor who spotted Relaxo Footwear when it was a small company and you held on, you made 100 times your profit, right? So choosing the investments, choosing your shares, it's a very personal thing. You need to do your research. And it also depends entirely on your risk appetite, right? There may be other small cap companies, but do you have the appetite to take that risk? Because the risk is that small company can go bankrupt. Yeah? Whereas if you're investing in a large company, the probability of that company to go bankrupt or do extremely poor is less. Now, which also means that Reliance Industries is not going to double in the next 1 month. Or at least it's not going to become 100 times in the next 10 years, right? Because it's already so big, right? So yeah, that would be my answer to your question. It depends on the risk appetite. It depends on your ability to hold on to shares for for X number of months or years.
Okay, sir. Next question. Who is demanding this much of gold from the market? Is it banks?
Right. So retail investors, I think India is one of the major demand for retail gold investing. But otherwise, it is large institutional investors which buy into gold. And another key thing to remember is firms like banks and investing firms, they don't buy physical gold. There is a product called ETF, Exchange Traded Fund. What they do is they track the price of gold. So you're not physically buying gold, but they track the price of the gold. Similar to oil futures, which we discussed. You're not actually buying or selling oil, but you're buying or selling the financial product linked to that. So it's mostly the large scale investing and the trading happens in the ETFs, which are linked to gold.
So one more question is there. What is happening to the cryptocurrency in this pandemic condition?
Cryptocurrency, yes. So honestly, I'm yet to I do not understand cryptocurrency enough to give you an expert opinion, right? So, I really don't want to kind of speculate. But one thing which I can say is that it definitely needs to be more regulated for it to gain authenticity. At the moment, regulation is near non-existent, and hence the authenticity of that is still lacking for most investors. Yeah. More than that, I haven't really done my research on that.
Okay, next question is from Amal. That is, I have seen Wirecard price falling to pound 1 from over 100 and it started rising pound 4 to 5 in the last couple of days. Do you hope it can get back to the original price? I have seen news of their insolvency. So would it be wise to invest in Wirecard?
I will not give any investment advice, but I can just explain probably what's happening here, right? It's the riskiest of the risky games which the traders are playing, right? So it used to be $100, €100. The news of the fraud and the scam came out, the share price collapsed. $2 billion or something like that is missing from their books. So declared bankruptcy. Now, there is some discussion happening that either the German government or Deutsche Bank is going to rescue the firm. If that happens, then it can climb up, right? So from €1 to 5, whosoever managed to invest got 5 times the money, right? It's huge, 500% in a couple of days. So again, it's like picking nickels in front of a road roller, right? If you have the risk appetite, you can try. If you're not careful, your fingers will get crushed. So that's a kind of activity which is happening in those space.
Participants? Okay, so one more question. The digital money investment will be increased in future. Thus the value. Okay, it is a statement by the placement. Okay, it is about the cryptocurrency. Hope the investment in cryptocurrency will increase. The digital money investment will be increased in the future. Thus the value of cryptocurrency will increase. So investment in cryptocurrency will also increase. It's actually from the part of the participant.
Oh yeah, that's fine. So so going back, I'm just going to repeat what I mentioned about the cryptocurrency, right? I'm not really an expert. A lot of big institutional investors do not deal in cryptocurrency because of the reasons I mentioned. It's not regulated. There is very less lack of transparency. There was even a very infamous case wherein one of the cryptocurrency firms, the key is that very few people know the password to the whole cryptocurrency infrastructure, right? So there was one instance where a big cryptocurrency exchange went completely bankrupt or disappeared one day because the founder unfortunately passed away and he was the only person who knew the password. So at the moment it's still in a very, very nascent state, and hence one needs to be cautious, but this is strictly my personal view.
I hope there is no more questions from the participants. Thank you all the participants, and over to Ms. Rintu Jose, Assistant Professor, Union Christian College, Alva, for the vote of thanks.
Good afternoon all. Honorable Resource Person of the Day, Mr Jayakrishnan Sir, my dear colleagues and our most valued participants. It's my privilege and honor to propose the vote of thanks on this occasion. I, on behalf of Union Christian College, Alva, and entire fraternity of this institution, first of all, I extend my most sincere thanks to God Almighty for making today's webinar a resounding success. It is with immense pleasure and gratitude that I express my heartfelt thanks to our chief guest, Jayakrishnan sir, who spared time from his busy schedule to grace our webinar. Today, we had an opportunity to hear your thoughts, and this will surely be going to enlighten and encourage us in these tough times. I am immensely thankful to the UC College management and principal for the enormous support and cooperation they extend towards us for these programs. A webinar like this cannot happen overnight. The wheels start rolling weeks ago. We have been fortunate enough to be backed by a team of very proactive and dedicated staff of our department, headed by Ms. Disha UI. I'm short of words for their involvement and express my deepest sense of appreciation for them. Many thanks to them. Last but not the least, a big thank you to each one of the participants for showing interest in this program and making it a success. Once again, I thank you all.
Thank you, Miss. Thank you, everyone. Thank you for joining into the webinar on a Saturday afternoon and listening patiently to me. Much appreciated. Thank you.